At 21 cents flat, trading up 2.4% on the day, Nuburu Inc. looks, on the surface, like just another forgotten penny stock drifting in the chaotic currents of the NYSE American Exchange. Most traders pulling up this chart right now are likely expecting the same old story: a company running on fumes, a desperate retail base praying for a miracle, and a slow bleed towards zero. That is the expectation. The reality, however, is far more complex and significantly more aggressive. What you are actually looking at is not a dying laser manufacturer, but a company in the middle of a violent, high-stakes metamorphosis into a diversified defense technology platform. While the market sees a 20-cent stock, the insiders are executing a strategy that involves acquiring Italian military software firms, partnering with drone defense contractors, and leveraging a proprietary physics advantage that could theoretically solve one of the biggest bottlenecks in electric vehicle manufacturing. Whether they can survive long enough to pull it off is the $10 million question, but to dismiss this as mere noise is to miss the mechanical shifts happening under the hood right now. Let's look at the immediate price action, because the movement we are seeing today is not just random fluctuation. That 2.4% green candle is happening against a backdrop of incredibly specific market pressure. The stock is currently sitting in a tightly wound coil. We are seeing volume metrics that suggest a battle for control at this 20-cent psychological level. The order flow today has been characterized by small, rapid-fire transactions, which often indicates retail accumulation absorbing the selling pressure from larger entities. But the real story is what is happening off the lit exchanges. When you look at the dark pool data, a significant portion of the volume, often exceeding 50% on recent trading days, is being routed away from the public eye. This kind of off-exchange activity usually suggests that institutional players or large block traders are positioning themselves without wanting to tip their hand to the broader market. They are managing their inventory, and in the case of a stock like Nuburu, that inventory management is directly tied to the massive short interest that has been building up for months. This brings us to the elephant in the room, the short sellers. You cannot talk about BURU without addressing the fact that this is a heavily shorted equity. Current data indicates that a substantial percentage of the float, estimates ranging between 16 and 27% depending on the data source, is currently sold short. That is a dangerously high number for a company with this market cap. It implies that a large contingent of the market is betting heavily on bankruptcy or a complete capital structure collapse. However, this level of pessimism creates a structural vulnerability for the bears. We have seen borrow fee rates fluctuating, often sitting in the high single digits, which makes it expensive to hold these short positions over time. Furthermore, the fail-to-deliver data, which tracks shares that were sold short but never actually delivered to the buyer, has shown spikes in recent weeks. When you see fails to deliver piling up, it is often a sign of stress in the lending market. It means there are not enough physical shares circulating to satisfy the obligations of the short sellers. If any positive catalyst hits, say a confirmed government contract or a funding announcement that removes the immediate bankruptcy risk, those short sellers could be forced to cover en masse. This is the squeeze mechanic everyone talks about, but you have to be careful. A squeeze is not an investment thesis, it is a market event. Relying on it is gambling, but understanding it is essential. If you are holding shares right now, comment below with your average cost basis, because I want to see how many of you are positioned for a turnaround versus how many are just trading the volatility. Now, we need to strip away the market stock mechanics and look at the actual business, because this is where the expectation versus reality gap is widest. The general assumption is that Nuburu is just a laser company that failed to gain traction. The reality is that their technology is based on a fundamental principle of physics that the rest of the industry cannot easily replicate. Most industrial lasers use infrared light. Infrared is great for cutting steel, but it's terrible for welding copper. Copper is highly reflective to infrared wavelengths. It acts like a mirror, bouncing the energy away. This makes welding copper components for electric vehicle batteries or consumer electronics incredibly inefficient and prone to defects. Nuburu builds blue lasers. Blue light is absorbed by copper roughly 13 times better than infrared. This is not a marketing gimmick, it's simple absorption physics. This allows for defect-free welding at speeds that infrared simply cannot match. The expectation was that this tech alone would make them a billion-dollar company. The reality was that industrial adoption is slow, and building lasers is capital-intensive. However, the company has recently pivoted. They are no longer just waiting for the laser market to catch up. They are aggressively expanding into the defense sector. The recent news regarding the acquisition of Orbit SRL and the partnership with Techne, a defense vehicle manufacturer, signals a complete change in identity. They are moving towards becoming a broader defense tech entity. The Orbit acquisition gives them access to software capabilities that can be integrated into military applications, while the Techne partnership opens doors to the European defense market. This is a classic roll-up strategy where a company uses its public listing to acquire assets and build a larger conglomerate. This shifts the narrative from struggling laser manufacturer to emerging defense contractor. The market has not fully priced this transition in because the execution risk is massive. Integrating an Italian software firm with a U.S. laser manufacturer is a logistical nightmare. But if they pull it off, the valuation multiples for defense software are significantly higher than for hardware manufacturing. Let's pause for a second and consider the short side again. Why are the shorts so confident? It comes down to the balance sheet. The financial reports show a company that has been burning cash at an alarming rate. We're talking about millions in losses against very little recognized revenue in previous quarters. The bears are betting that the company will run out of money before these new acquisitions can generate cash flow. They are betting on dilution, the idea that the company will have to print millions of new shares just to keep the lights on, thereby crushing the value of existing shareholders. This is a valid fear. Actionable insight for you. Watch the filings for at-the-market or ATM offerings. This is where the company sells new shares directly into the open market to raise cash. If you see heavy selling volume without any news, it could be the company itself raising capital. On the flip side, watch for inside buying. If the management team, particularly the CEO or directors, starts buying shares on the open market at these levels, it negates the bankruptcy thesis. It is the single strongest signal that they believe the financing gap can be bridged. The defense angle is particularly interesting given the current geopolitical climate. We are seeing a global rearmament cycle. Nations are increasing defense spending, specifically on drone warfare and electronic countermeasures. Nuburu's blue laser technology has potential applications here as well, specifically in directed energy systems or dazzling sensors on enemy drones. By partnering with Maddox Defense and acquiring Orbit, Nuburu is positioning themselves to bid on these types of contracts. The expectation is that government contracts take years to materialize. The reality is that in the current environment, rapid prototyping and off-the-shelf procurement vehicles are being used to fast-track technology to the field. If Nuburu can demonstrate a working prototype that combines their laser tech with a drone platform, the timeline to revenue could be much shorter than the market anticipates. There is also a retail sentiment aspect we need to discuss. If you check the forums and social media channels, there is a distinct divide. One camp believes the management is simply diluting shareholders to pay their own salaries. The other camp believes the stock is being artificially suppressed by naked shorting and is due for a violent correction to the upside. When you see this level of polarization, volatility is guaranteed. The smart money is likely waiting on the sidelines for proof of life, specifically the first consolidated earnings report that includes the financials from the new acquisitions. That report will be the moment of truth. It will show whether these new assets are generating real cash or if they are just adding to the burn rate. Speaking of market manipulation and short selling, let's talk about how you can actually track this. Don't just rely on the headline short interest number, which is often 2 weeks old. Look at the borrow fee on your brokerage platform. If that fee suddenly spikes from 7% to 30% or higher, it means the supply of lendable shares has dried up. That is often a precursor to a squeeze. Also watch the options chain. If you see a massive accumulation of call options at the 50-cent or $1 strike prices, it implies that traders are positioning for a gamma squeeze, where market makers are forced to buy stock to hedge the options they sold. Right now, the options activity is relatively muted, which suggests the market is in a wait-and-see mode. This quiet period is often the calm before the storm. We also need to discuss the risks in more detail. The primary risk here is not just the technology failing, but the capital structure. When a stock trades below $1 for an extended period, it faces delisting risks from the exchange. Nuburu will eventually need to regain compliance with the minimum bid price requirement. This often leads to a reverse stock split, where the company consolidates shares, say 1 new share for every 10 old ones, to boost the price. While this keeps them listed, it's historically a negative signal for the stock price in the short term, as it is often followed by more selling. However, a reverse stock split is not always a death sentence. If it is done in conjunction with a major positive announcement, it can sometimes mark the bottom. But you need to be aware that this card is on the table. What is your take on the rising short interest? Do you think the bears are smart money, identifying a terminal zero, or is this blatant manipulation of a company trying to pivot? Comment below, because the distinction between smart shorting and predatory shorting is often just a matter of timing. Looking forward, the catalyst calendar is crowded. We have the integration of Orbit, the closing of the Techne deal, and potential announcements regarding the defense joint ventures. Any one of these could trigger a repricing event. The blue laser business itself remains a sleeper agent. If a major EV manufacturer like Tesla or BYD were to announce a validation of blue laser welding for their next-gen batteries, the stock would likely decouple from its current technicals entirely. The industry knows that infrared lasers are hitting their physical limits with copper. The switch to blue or green lasers is inevitable. The question is merely